Hi, welcome to the first part of this module, Audit and Assurance. Like I told you in the introductory video, Audit and Assurance is made up of 5 major components: the regulatory framework, planning and risk, internal control, audit evidence, then review and reporting. And like I said, we are going to structure the case studies around these major components to prepare you for the exam. So for the regulatory framework, we're going to have 2 case studies, just like I said in the introductory video. So by now you would have downloaded the case studies and you would have gone through the first case study. So let's go and have a debrief of the first case study, that is on cinnamon. So you find in the video that, in the case study, that Salt and Pepper, they are a professional accountancy firm and audit firm that has been contacted by Cinnamon. Cinnamon has requested that the financial statement be completed by the end of February because they need to make some filing. And then Cinnamon has decided that because the request has come at a time that they are very busy themselves, they are going to use junior audit staff member for the audit assignment. They have also decided that they will not need to update their engagement later. And also, because of want of time, they are not going to be able to contact the outgoing auditors. So this is the brief summary of what is contained in this case study. But if you see the questions that follow, the questions may not directly draw from the case studies. They are designed to test the things that you should know in regulatory framework. When it comes to regulatory framework for audit and assurance, you should be able to know things like assurance, the difference between assurance engagement and regular audit assignment. You should be able to know something about corporate governance. You should be able to know the content of an engagement letter. When an engagement letter is issued, who writes it and what are the key things that should be there. You should be able to know the steps that an auditor should take before they accept an audit assignment. You should be able to know what preconditions should be on grounds before an audit assignment should be accepted. And then you should be able to know the ethical principles contained in the ACCA Code of Ethics, which is adapted from the IFAC Code of Ethics. So for these 2 case studies, we are going to cover about 80% of those concepts, and the other ones we are going to cover them when we go to the objective test segment of this course. So for now, let's look at the first question. The first question that you were asked after that case study is, what are the steps that Salt and Pepper should take before they accept the audit assignment that has been given to them by Cinnamon? The first thing they should be able to evaluate is they should be able to find out if there are events or an event that will make them compromise their independence as auditors. Do they have self-interest in this audit? Are they in a position where if they undertake the audit, they are going to compromise their independence? Because it's one of the requirements of the ACCA Code of Ethics that the auditor should be seen to be independent in mind and in appearance. So they will be able to evaluate the circumstances to see if at any point they are compromising any of the ethical principles. If it happens, it's violating their independence, and in that case, they shouldn't accept the audit assignment. The second thing they should be able to take into consideration is, do they have the requisite competence to undertake the audit assignment? What that means is that apart from, the fact, like you heard from the case study, that they want to use junior staff, that might not be actually the core implication of competence. Competence is, let's assume this company has been auditing manufacturing companies for the 5-10 years since they existed, and they are supposed to take on an assignment in an insurance company or financial services company or a fintech company. They should be able to assess if they have the requisite competence to be able to take on an audit in an area or a field that is different from what they have been doing before. Another thing about competence is that if you have to audit, let's say, a real estate company that is into property development, and they have property that they have built and is not completed, and you want to evaluate them as work in progress, what values do you attach to this property? You would need the services of an expert. If you cannot arrange for that, then you don't have the requisite competence to undertake the audit. The next factor to take into consideration is the integrity of the management. If the organization you are auditing do not have management that have integrity, the management will window dress the financial statement. They want to compromise the standard of the audit. They will not prepare the account in accordance with requisite financial reporting framework. And if management do not have, if you do not know the management personally, you may want to ask them, for references, from reputable organizations where you can now place reliance on to be able to assess the integrity of the management of the company. The next thing is to assess the level of risk involved. What will be the 3 kinds of risk in audit? We're going to deal with that as we go into planning and risk. We have the inherent risk, we have control risk, and we have detection risk. Inherent risk is a risk that arises because of the nature of a business. So, if you were into audit of fast food, for instance, the inherent risk, just a simplified example associated with a fast food business, is that food will be subject to defalcation and theft, because these are raw and cooked food. And also you have that is the risk from this side of an auditor, trying to dictate if some food has been stolen. Or the risk to the business, which they will call business risk, could be the fact that if people have food poisoning, for instance, then they are going to be a subject of investigation. So, but I'm just saying that the auditor will need to assess the level of risk associated with the business. The way the accounts have been prepared will be a risk to an auditor. The timing of the audit, the level of restriction they have, all those will be the kinds of risk an auditor should be exposed to. If they feel that the risk exposure compromises their independence, then they should decline the audit assignment. And then the next thing to do is to communicate with the outgoing auditor. It is very important. Is required, or is in the code of ethics for professional accountants by ACCA. You need to communicate with the outgoing auditor to find out if there would be professional reasons for why you should not undertake the audit assignment. They should be able to also fill you in on the nature of the company and the risks that you may not have anticipated. So these are the things, that the steps they should take prior to accepting the audit of Cinnamon. The thing I wanted to note especially is that the next question says, what are the preconditions that should be in place before an audit assignment can be undertaken? Remember that these questions can be peculiar to Cinnamon, but they They look like they're peculiar to cinnamon, but they are applicable to every kind of audit. So when they ask you the preconditions for an audit, it is different from the steps an auditor should take, before accepting an audit. When you talk about preconditions that should be in place for an audit assignment to be undertaken, there are two of them. There are two. You see me, I have put them in bullet points here, but it's a summary of two major points. The first point is the financial statement must have been prepared using acceptable financial reporting framework. Then the management must understand and accept their responsibilities with respect to the financial statements that have been prepared. These are the two preconditions, but we now break them into smaller sub-conditions. For the reporting, you need to assess that the financial statement have been prepared in accordance with appropriate and acceptable regulatory and reporting framework. That means that they must have followed accounting standards to start with, and the financial statement have been prepared according to format prescribed by the kind of industry in which the business operates. For instance, apart from preparing a financial statement in accordance with, let's say, International Financial Reporting Standard, if this company is in the financial services industry, the respective disclosure requirements that are required of financial service industry must also be disclosed as part of the financial statement. In that case, we say the auditor should have determined that the financial statement have been prepared in accordance with acceptable, reporting framework. Then they need to obtain agreement with management about the understanding of their responsibilities. Number one, the management will take responsibility that they are responsible for the preparation of the financial statement in accordance to applicable financial reporting standard. They will understand and accept that they are supposed to design the internal control of the business. The internal control should be designed in such a way that it will help the company to prepare the financial statement that is free from material misstatement due to fraud or error. And they need to understand and agree that they are supposed to provide the auditor with unrestricted access to the books and records of the company, including making management representation. We'll talk about that as we progress. If the preconditions are not present, the auditor should discuss with the management. So if they discuss with the management, they take two decisions. Normally, the decline decision will be on these conditions. Number one, if the financial statement has not been prepared according to acceptable financial and regulatory reporting framework, they decline the audit. They also decline the audit if the management refuse to understand or accept that they have responsibilities to prepare the financial statement, responsibility to design and maintain the internal control, and also the responsibility to give the auditors unfettered access to all the books and records of the company. The next question that we have been asked, the C part, had asked us to, to state the matters that should be included in an engagement letter. The engagement letter actually is a contract between the audit firm and the company which they are auditing. So it is the document that sets out the contract between the auditor and the company that they are auditing. Normally, it is the auditor writes out the engagement letter, lists out the terms of the audit assignment, and then passes it over to the company to confirm and sign up. The list of the things that I've stated here are not exhaustive, but they are enough. If you were asked to list the matters to be included in an audit engagement letter, and they put 6 marks, that means you should state like 12 points. If they put 3 marks, you should state like 6 points. So that might be like half mark per point, per item to be included in an engagement letter that you have listed. As we proceed, we'll be looking at current and permanent audit file. So an engagement letter should state the objective and scope of the audit. Clearly, the objective of an audit is to enable the auditor express a professional opinion on whether the financial statements are true or fair. The auditor do not give absolute assurance, they only give a reasonable assurance. The engagement letter will state the responsibilities of the auditor, which will be to express an opinion and to carry out the audit in line with available international auditing standard and any regulation that they are supposed to be subject to. And then the engagement letter will state the responsibilities of the management, which we said earlier that it is the management responsibility to prepare the financial statement. They are to design and maintain the internal control system. The engagement letter will identify the financial reporting framework that has been adopted by the organization. The audit engagement would state, engagement letter will state the expected form and content of any report to be issued. Normally, the auditor will give what we call the auditor's report. They will state the format and the content of the report. They can elaborate on the scope of the audit with reference to legislation. So which applicable legislation are they going to, this other point is not there, which other legislation are they going to be making reference to? International auditing standard, international accounting standard that they are going to follow in their audit assignment. If they have communication with the company or any third party, what will be the mode of the communication? For instance, there's what we call letter of secularization, where the auditor may need to write to debtors or creditors to confirm the amount for which a company has stated that they are indebted to them or they owe. So the letter of secularization, the auditor could seek permission to write to the people directly, or they'll use the company themselves to write and then ask that the reply should come to them, the auditors. So you need to agree on how the mode of communication is going to be, and even the results of your finding. Who are you going to communicate it to? You are also going to state in an engagement letter that some material misstatement may not be detected. I didn't say it earlier. It is not the responsibility of the auditor to dictate fraud, but they carry out their audit in such a way that if there was fraud in the financial statement, they should be able to detect. But the objective of an audit is not to dictate fraud. So they also make arrangements regarding the planning and performance of the audit, including the composition of the audit team. In other words, how long will the audit take? Is it going to be 1 month, 2 months, or 3 months? And they're going to state the number of this audit staff members that are bringing to the audit assignment. And then there's an expectation that management will provide written representations. So normally, for items like inventory count, the auditors may not be able to go to every site. So let's assume that we were auditing an automobile company and they have 50 locations across the country. The auditor would have a schedule of inventory of these vehicles on paper. They might want to go and confirm that the number of cars are available at a particular time, but they may not be able to visit the entire 50 locations. So they can decide to visit, let's say, half, So if they visit half of the locations to confirm the inventory count, they will have to obtain written representation from the management that the inventory count from the locations that the auditors have not visited are correct as at the date at which they were counted and stated and handed over to auditors. That is one example of written representations. So the next question that we were asked is, what will be the quality control that the salt and pepper should apply in carrying out this audit assignment? The quality control may just change slightly from one assignment to the other, but what we've stated here can pretty much be applied to any other audit assignment. And the first one is that the audit team should be properly briefed about the client to enable them obtain an understanding of the client before they start their work. So there's what we call obtaining an understanding of the client's business, whether new or old. Every time the audit team members are supposed to go out for an audit, the team members, they need to be briefed. If they are changed, if it is a continuing client, they need to know if there have been changes to the business model of the client for the past year that they have not visited there. And if they are new members of the team, they need to be appropriately briefed the nature of the business, the kind of risk associated with the kind of business that they are going to go and audit. That is one quality control they should apply. They should also be able to employ adequate supervision, because their plan is to use junior team members. So if the junior team members are not adequately supervised, they could make rookie errors that will become a burden to the entire audit team. So the supervision will also enable the progress of the audit team to be tracked, and any error will be quickly identified. So they can employ what we call an engagement quality reviewer, to be assigned to the audit. So engagement quality reviewer is somebody that, reviews the work that is being done or the work that has been completed to see that they have been performed according to standard. So when you go out for audit assignment, we have what we call the working papers. The observation of the audit team members are written or stated in the working papers. Any clarification that they need to seek, they have to get to the contact person provided by the company to seek those clarifications. And if issues have been resolved, they state that those issues that they have stated have been resolved. So the engagement quality review, we need to see that the observations made are correct and the resolution processes have been followed properly. Now, one of the things that we can do is either appoint an engagement quality reviewer from outside the team that are currently on the audit of Cinnamon, or get another quality reviewer from a different audit firm to carry out the review. So the review work should be performed more frequently to identify issues properly, so that they can be raised with the client and resolved quickly. And then you can assign more audit team members. Since they are saying the work should be completed expeditiously, you can assign more team members to the audit, and that will take away the pressure on the team members that are already present. And once that is done, we find that the audit will be performed according to quality. But the points I've raised here can be adapted to any other audit. Then they ask you to identify finally the ethical issues and resolutions. the issues, this is the most prominent, this is the questions that prominently addresses the issues in the case study. All the other things that we've done so far can be applied to any other audit, but the answers here are specific to this case study. So what are the risks from the case study that you've seen? You see, when I gave you the summary before we started, which you also have in your case study, which is before you, I gave you the summary around the ethical risk that has been identified. Number one, the salt and pepper wants to use junior staff for the audit assignment. So junior staff, to undertake a high risk audit, you need to use experienced team members, or you have a blend, have an appropriate blend of those who have experience and those who are just rookies, so that it will minimize the risk associated. So you can either, because the reason they gave was that they are engaged in other audits. So since this audit is a new one, the client is new, and they are asking that the assignment should be completed promptly. One of the things they can do is to switch experienced team members from another audit to this one, or they increase the number of staff, or they talk to the management of Cinnamon for them to extend the time they're supposed to turn in the report, so that the junior staff that are on this assignment can have more time to understand the business and give render proper service to the firm. So Salt and Pepper have not contacted the outgoing auditors, and what they say is that because of time. Actually, this is ethically wrong. If they have not contacted the outgoing auditor, apart from violating ACCA ethical code, one of the things is that they will fail to identify the high risk area or any professional reasons for which they should not undertake this audit assignment. So they have said they are not going to update their engagement letter. Year to year, issues change, and the things that you may need to identify early enough, because I have told you earlier that an engagement letter is a document that sets out the contract of an audit between the audit company and the company, that audit firm and the company that has been audited. So if the basis of a contract for an audit assignment are not well defined, then you cannot expect the audit to be conducted properly. So some of the things in this engagement letter may not be applicable to this audit firm. So what they should do is to review their engagement letter for every audit assignment. So an existing client of Salt and Pepper has proposed an audit firm based on existing staff actually of Salt and Pepper has proposed an audit fee based on a percentage of the client's final pre-tax profit. It is a violation of ethical code, because it puts you in what we call a self-interest threat. So this was supposed to be AND. Self-interest. So when your audit assignment is based on profit before tax, you want to, even if the company staff have window dressed their accounts in order to obtain in order to make the financial statement look promising to or juicy to the shareholders, the auditors will not be able to challenge it because that financial statement is also going to increase their fee. So we don't accept contingent fee. That's called contingent fee. We don't accept contingent fees in an audit assignment. So fees will be based on the level of work required, the hours they are going to put in, multiplied by the hourly rate of the respective audit team members. Those are the basis for calculation of audit fees. So at this time, we've come to the end of the first case study. So these are the brief but the key things you need to take into account as we are from the first case study, the steps an auditor should take before undertaking an audit assignment, which is different from the preconditions that should be in place before an audit. Then we look at the content of an audit engagement letter. We looked at the quality control that should be applied by this company, and we look at the ethical threats that have been highlighted here and the resolutions or the steps taken to rectify them. Thank you so much. See you in the second case study for the regulatory framework, and then we build on like that until we go to review and reporting. Thank you.